He had done everything right. 61, saved for decades, careful with every dollar. And he sat across the desk from me and asked why his retirement kept sliding a year further away. It took about 10 minutes to figure it out. He'd become the family bank. A little for a kid here, a little to a parent there. Even co-signed on a loan he'd half forgotten about. And none of it felt like much. All of it added up to real money out of his own future. I've watched this happen more times than I could ever care to count. And today, I'm going to show you what it's actually costing you. And how to say no without guilt. I'm Tim Gardner. And in my 30 years of building hundreds of retirement plans, I've watched this one mistake derail more futures than any market crash ever did. And the people making it are almost always the most generous ones in the room. So here's what I want to give you. The specific ways of being the bank quietly drains your retirement you spent a whole life building. One simple rule that stops it, and the words to say no to the people you love without feeling like a bad guy. Stick with me to the parent part near the end. That's the one that almost no one sees coming. And it's almost always the most expensive. It's the phone bill you never took off your plan. It's the rent you covered once and again, and now it's just part of what you do. The car you co-signed, the wedding, the grandkids' tuition, the groceries you quietly pick up for your mom. None of it ever feels like a decision, though. And that's the problem, because you never sat down and chose to become the family's line of credit. You just said yes, one reasonable time at a time, until yes was the default. Hey, and look, I'm not preaching from the mountaintop here. I still pay a couple of my grown kids' phone bills. Now, the ones that have jobs pay me back. The others, we're working on it. So this is not about never helping your family, because helping the people you love is one of the great things in life. That's not the problem, and I'm never going to tell you that it was. But here is the problem. A bank has terms. Banks have repayment schedules. Banks ask for collateral. And banks have an end date. You have none of that. You're giving from love, which means there's no contract, no due date, and no underwriting either. And love, as it turns out, is a terrible loan officer. There's a difference between helping because it brings you joy and helping because you feel guilty or concerned. The first one is generosity. The second is a slow leak. Now, keep in mind, real emergencies are their own thing. If your kid's in the hospital, you're not going to sit down and run a spreadsheet. I'm talking about the steady, quiet stuff that becomes permanent while you're not really looking. So here's the rule I give my clients. Be the donor, not a bank. Because you see, a donor decides, on purpose, from the money they already set aside, with their eyes open. A bank just keeps the window open and lets people walk up. 3 parts, and I want you to remember them. Give on purpose, give from surplus, give with a plan. On purpose means you decide before anyone asks. From surplus means your own retirement is funded first and those accounts are completely off the table. And with a plan means you know what the gift does to your taxes before the money even moves. Let me show you what it costs you when you skip that last rule. Because often the price tag is bigger than the check you write. Start with the money itself. The dollar you give away in your early 60s is not the same dollar you gave away at 40. It comes out of the most fragile window of your whole retirement, the first few years, when a withdrawal in a down market can do permanent damage. It never gets the chance to compound for you again. Just run the math on the small stuff. $1,000 a month to a kid doesn't feel like much. Over 10 years, invested the way your retirement money would have been, that's somewhere north of $170,000. You know, that $30,000 you just helped out with was never $30,000. It was the 90 it would have become, plus the withdrawal you now have to make to cover your own life. Now here's the part your advisor and your CPA both miss, because it lives in the gap between them. When you sell stock or pull from your 401k to fund one of these gifts, you don't just spend the money. You spike your income for the year. And that number, your MAGI, your modified adjusted gross income, quietly controls things you simply can't see. I had a client do exactly this. Late in the year, he told me he sold some stock to help pay for a grandchild's tuition. Generous, extraordinarily kind. But that sale raised his income enough to bump him into a higher Medicare bracket 2 years later through what's called the IRMAA Lookback. Same help, but now it cost him $2,300 in extra Medicare surcharges he never budgeted for, and nearly wiped out the deduction he had been counting on too. Same money, different timing, completely different tax bill. Then there's the one that feels generous but backfires the hardest. Giving a kid a house. Or a piece of one. Because when you hand someone property while you're still alive, you also hand them the original cost basis. That number you bought it at years ago, so when you go to sell, they owe tax on all that growth. If they'd inherited it instead, the basis steps up to today's value, and most of the taxes disappear. I've watched parents give a child a house and accidentally hand them a huge tax bill in the process. The kindness was real. The mechanics quietly undid everything. And cosigning. Quick one, but it's important. Remember, when you cosign, you just don't help with the loan. You now own the loan. It's your debt, your credit, eating into your own ability to borrow when you might really need to, because you didn't lend a hand. You lent your entire balance sheet. If you're worried about these leaks, there's a diagnostic in the description called the Wealth Clarified Score. It's how you see exactly where you stand. Now, let's talk about your parents. Here's the part I told you to wait for, because I know a lot of you aren't just helping a kid. You're helping a kid and a parent at the same time, out of the same paycheck. And the money you send to an aging parent follows some very different rules, and the mistakes are even bigger. And here's the big one. If an aging parent ever needs long-term care, and most people will need some, the bill can run into hundreds of thousands of dollars. There's a program that can help with that, Medicaid. But it looks back 5 years at how the money was moved. Shuffle a parent's assets around the wrong way to help, and you can accidentally disqualify them right when they need the care the most. Helping the wrong way can cost a family far more than the help was ever worth. There's also money on the table most families never claim. Veterans benefits for parents who served. But nobody applies for it because you're quietly covering everything, because on paper the problem just looks solved. This is where the right paperwork matters more than the right check. Enlist the help of an elder law attorney, a power of attorney signed by your parents while they're still healthy enough to sign one, and long-term care coverage bought before they're too old to qualify. And one last thing. The timing on long-term care can be brutal. In a recent article from Morningstar, Christine Benz laid out the numbers. 88% of people who apply for long-term care insurance between 65 and 69 get turned down. After 70, that number's nearly half. So wait until you obviously need it, and that door's already closed. And she made one more excellent point worth sitting with. When there's a policy already in place, the kids are far more willing to arrange care, because they're not watching it drain their parents' savings or their own inheritance. The coverage doesn't just protect your parents, it takes you off the hook. This is the actual checklist I walk clients through when a parent is aging. 40-some questions across cash flow, estates, taxes, insurance, and assets. Let me tell you, most people have never seen half of it. If you want me to run your own parent situation through it with you, that's what a call is for. So let's get to the part of the title I promised. How do you actually say no to the people you love without feeling like a villain? 3 things. 1, decide the tier before the ask comes. That's the whole game. You see, if you've already decided in a calm moment that you can gift a kid $5,000 towards a wedding, and that's the number, when the ask comes, you're not negotiating with them over the guilt in real time. You're generous, with purpose. A planned gift is a gift. An ambush is a bailout. The difference is whether you choose to do it before or after the phone rang. The second, make your retirement accounts non-negotiable, then make it automatic. The 401k, the IRA, the Roth, those aren't resources for the family. They're the thing that keeps you from becoming the family's problem later on down the road. Automate the contribution so the money's gone before anyone, including you, can reach it. Take willpower out of it. Third, the words. And this is where I've seen some really good people tie themselves into knots. You don't owe anyone a 5-paragraph explanation, because explanations invite negotiations. The more reasons you give, the more surface area there is to argue with you. So keep it short. Something like, "That's not something I can do right now." And then stop talking. Let the silence sit. It's not your responsibility to fill the silence. And here's the trick that works. Rehearse the guilt trip in advance. You already know what they'll say. You know the line that's going to get you. So practice it out loud before it comes so it doesn't knock you off your feet in the moment. Activity is the antidote for anxiety. Decide the number. Automate the accounts. Practice the sentence. 3 small moves and the guilt loses most of its grip. Because here's what I actually want you to hear. The real disaster isn't saying no. Saying no is uncomfortable for an afternoon. The real disaster is the other road. You know, the one where you gave and gave until you ran yourself down, lost your own independence, and the kids you spent everything helping now have to take you in and take care of you. That's the thing the family bank was supposed to prevent. And it's the thing being the family bank causes. So, protecting your retirement is not the selfish choice. It's the generous one. It's you making sure that 30 years from now, you're still the person who can help, instead of the emergency someone else has to solve. Saying no today is how you keep from becoming the ask tomorrow. Give with purpose, give from surplus, and give with a plan. Hey, if this is the first time anyone's framed being the family bank as a money problem and not just a feelings problem, do me a huge favor and hit like. It helps us reach the next person who probably really needs to hear it. And most of them have no idea what they're doing. And if any of this hits a little too close to home, that's exactly the kind of thing we do for our clients. We look at the whole picture and catch the leaks before they cost you. That grandchild's tuition, the parent's care, the gift you're about to make, all of it in one place with someone whose job it is to see how those pieces connect. And if you're not ready to talk to anyone just yet, run the Wealth Clarified score. It's down in the description, and see where you stand for yourself first. When you're ready, we're taking on a few new clients right now. Come on by, say hello. But stopping the family bank habit is only the first step. But there's one specific bill that catches almost every parent off guard and can wipe out years of savings in one single stroke. It's the college tuition. And if you're worried about how those bills are going to affect your retirement, you need to watch the next video where I break down the 3 moves you must make the moment that tuition bill arrives. I'm Tim Gardner, and I'll see you in the next video.